Welcome to the Zacks Roundtable Review, a discussion of current events affecting investors as well as other topics of financial interest, featuring the analysts and editors of Zacks.com. Taper talk, market volatility, the jobs data that just came in last week, and more. Our strategists weigh in. Joining us this time around, senior equity strategist Jared Levy, equity strategist Tracy Reinick, and ETF strategist Eric Dutram. So with Friday's jobs data that came out, is that report strong enough to impact all of this taper talk that's going on out there, Tracy? You've said that it's kind of a middle-of-the-road report, and that a middle-of-the-road report would neither be good enough to make the Fed stop QE or bad enough to freak them out.
Right. I mean, it was not that great. I know the market seemed to like it a lot more, but I mean, it wasn't awful. It's above 100, but we should really be above 200 at this point. But we're not, so fine, we'll take it. But it does mean, I think, that the Fed is going to be a little more cautious here in ending QE, which, of course, is what the market loves, because that means the party can go on as far as them pumping money into the system. So in that way, it was good, but I don't think the number was anything to get excited about the overall economy.
Okay, Jared, you feel that the Fed is going to just take that report as on course?
Yeah, I mean, it was, Tracy said it was like the Goldilocks perfect porridge report, right? It was right, basically just a little bit better than in line, which I think was better than being a little bit worse than in line, if that makes any sense. I think right now, what it does for the Fed is it says, okay, things are sort of status quo. My concern, and what I'm starting to hear a lot of talk of, is change in bond yields, a shift away from equities into bonds as, if rates do begin to increase. People are starting to have these conversations about changing rates. When are those rates going to change? And that would happen again with the Fed tightening. I tend to be a little bit more of a, I guess you would call it a hawk. I think the Fed begins to tighten sooner than later, perhaps as early as September, December. But again, there's a lot more data needs to be happen. A lot more data needs to come out. I think Tracy was on point in the fact that it was a Goldilocks report. It wasn't fantastic. It hasn't been fantastic, and for now, it keeps QE flowing into the markets, and that's why stocks are up.
Eric, you thought if the report came in really terrible, that would even be good for the market.
Well, I agree with that, yeah, and I think to kind of go along with what Jared was just saying, I don't think there's any chance that the Fed will taper off the QE this year, at least based on this report, because we saw the unemployment rate tick up to 7.6%. We saw some revisions lower for the previous month. So, there's really no jobs, not enough jobs being created to really push down that rate. And that's one of the things the Fed is really looking at. So while I agree with Jared that,
you don't agree with that at all.
Well, no, I agree that maybe they should think about it some more, but I don't think they're going to unless we get the unemployment rate far lower than it is right now.
Jared's actually gone on the hook and said that if not begin tapering at the September meeting, maybe if they don't even start introducing the new language sooner.
Yeah, okay, so the unemployment rate ticked up because the participation rate actually, for the first time in a long time, I think it did once on the time, it actually moved higher. Typically, the participation rate's been dropping, which means unemployed people are actually coming back looking for jobs, which is kind of a weird positive thing. That's what I'm saying. There are so many pieces to this report, it's really hard to digest. My point is you've got, a bunch of Fed presidents. It's not just Bernanke that makes the decision. You've got several people, and we've seen that dissension. If you look at the minutes, you look at the beige book, there is a dissension. There is sort of a dichotomy inside of the Fed, and people are starting, some members are saying, I'm not too comfortable with this whole QE thing. We're starting to see that voice a little bit more. Again, it's all hypotheses at this point. Everybody's got valid points.
So then let me ask this. We have 3 more employment numbers before the Fed meets in September. Given what was reported on Friday in the May jobs report, you think that these numbers are going to be a key market driver between now and then?
Definitely, and I think that and earnings season coming up next month, that will probably be another huge catalyst for the market, because there's really not that much else that's happening. I mean, we got some more housing numbers, and then later this week, retail and consumer sentiment. So I think those figures will also probably be important for the next couple weeks.
Yeah, but the economic data docket is pretty sparse here going forward.
For this week you're talking about?
Yeah. And so that means few catalysts this week impacting the stock market. So my $64,000 question is, how are the bulls going to be able to stay in control between now and the next Fed meeting, which is on June the 19th?
With no change, the bulls are in control. I mean, let's just say, the market has been just levitating higher and higher and higher. And even a guy like me, I think, is a little bit probably more bearish than my colleagues. You have to just say, you know what, the path of least resistance is up. To Eric's point earlier, I think that we've seen the best jobs report that we're going to see all summer. I think the next 2 to 3 jobs reports are going to decline like they did the past 3 summers. Again, that's just my opinion. And I say that because, again, it's typical sort of the summertime season. This past strong report, I think, was actually a little bit better than what I was expecting. I think a lot of people were expecting. And remember, there's a standard deviation of 100,000 jobs. That's the margin of error for that report. So.
But if this is the best job report, then how does the Fed even conceive of tapering?
Right.
Why would they even think about it? They'd be like, wow, we're only at like
asking that.
125.
There's my conundrum.
Yeah.
And again, this is why I'm in conflict with myself, because a piece of me is like, this economy stinks. I don't like QE because I don't like the Fed sort of meddling with the natural way of things. But you're right. I mean, it's. If it does continue to decline, will they taper? My view, again, goes back to the fact that I think there's going to be a sense of logic and I think a sense of worry that, inflation and we could be causing a bigger problem than we're solving. But
Tracy, are you going to be paying attention to the Bank of Japan meeting this week for any indicators as far as impacting the global stock markets, not just ours?
Sure. I mean, anything happening in Asia, I think, is really important right now. And I do think it's interesting to see that, the Nikkei has really basically crashed here. Nobody's paying attention. We had a gold crash, we had a Nikkei crash. Turkey's not looking too good, its stock market. So there's these little bit of cracks in the facades of the global, assets here. That is a little worrisome to me, at least, but it hasn't totally started building on itself, but we're starting to see issues that are kind of dramatic. I mean, these aren't like small sell-offs. These are like 1 week, 2 week things.
This Tracy brings up a great point. The Nikkei, right? Japan was noted as like the #1 market for Tiffany's. They had a great report that like Japan was a strong market. Yeah, well, the market was up 70%. It's now crashed, like 30% or something, 20%. I mean,
it's still up like 25% year to date, though.
But
and then actually today, the market over there was up about 5%. So they're still trying to get back to these boom times from a couple months ago.
But none of that is normal, though.
Right, yeah, it's pretty
these
insane volatility.
up 5%, down 7%. I mean, that's not normal for a big index like the Nikkei.
So bottom line, bulls are still in control here?
Bulls are still in control.
Over the near term. And what about volatility? Is that going to be a watchword here going forward?
It's going to stay elevated. We're going to continue to see elevated volatility.
All right, well, at least we settled on a couple of different items on the docket for this time around. They're going to show you or share with you their top stock picks, and that's in our next segment. So click on over.